automatically it goes into very deep deficit. So the expectation was that, they may either remove or reduce the ICRR, but we have to wait and see. If they do, it's very good for banks. But over to you.
Okay, thanks a lot, Lata, for that. Well, let's head into the market opening now. The first tick on the index is in the green, up almost about 30-odd points. The Sensex is up about 70-odd points as well. It's a decent start, actually. The mid-cap index is up about 150 points too. So not a bad opening at all for the market. The advanced decline ratio is at 1,800 stocks on the advancing side. If you look at the big movers this morning, L&T is up almost about 1.5% on the back of that order win, the impending order win that is, so 1.2% higher. Tata Steel, NTPC, Bharti Airtel, Bajaj, Finserv are all up about 0.5 to 1%. The other stocks in the green are Maruti Suzuki, ONGC, Power Grid and Bajaj Finance, looking pretty good there, 0.5% higher. While on the downside, names like Hindalco, Axis Bank, Infosys, HDFC Bank and Britannia are leading from the front. That's on the downside. But the market is largely very quiet. The space to be in definitely once again is the mid-cap end of trade. Big double-digit moves in many names actually. Mazgaon Dock, of course, is the one that's leading from the front. And of course, Nigel will talk more about that. But in general, the space to be in is in the broader markets. The Nifty, by the way, at 19,750 is less than 2% away from that all-time high of almost 20,000. The mid-cap index once again is at a record high. So this is a good-looking screen, although it may not look like as much of a big move on the headline index, but slow and steady the market is inching higher and there is plenty of participation in the broader markets. The Nifty Realty Index is also picking up quite a bit, up almost 1%, so there is quite a bit of participation on that end as well.
Well, that's right. So, talking about Mazgaon Dock, just take a look at Kochi Shipyard as well. There was a downgrade coming in from Kotak today, downgrade to sell from buy, but that stock's not stopping. Kochi Shipyard is up close to around 7% as we speak. Transformers and rectifiers, a smaller stock, but volumes are very high. 8 lakh shares traded in the first minute itself. So keep an eye out on that one. It's up more than 10%. The other couple of notable movers are IRB Infra. This I'm talking about volume buzzers in the first couple of minutes itself. UCO Bank as well is higher in today's trading session. And RVNL as well continues to march along. On the downside, you have JNK Bank that's down 2%. MMTC, after rallying close to around 50% in this week, that one's pulled back close to around 2% and volumes very, very high on that one. And smart meter maker Genus Power has corrected from around 295, it corrected to around 265. For starters, that stock is up 2.5%. And the metal stocks continue to do well. PSU Metals in particular, NALCO and NMDC, both of them higher in trade. Prashant, what else?
You can only look at and marvel at what's happening with these shipbuilders, right? It's incredible what's going on. And you can marvel and maybe make jokes, Sonia and Nigel. I was thinking, what would you say for something like a Mazgaon Dock? I was thinking, the ship is sailed would work. Right? Just nowhere near docking. The ship of dreams.
I think we'll have to think about that. I think you had come out with a good one for defense, right? Defense on the offense.
Where do you come up with all this? While you stay up at night, while you stay up at night tracking the US markets, is that the end?
I just thought of it right now. But it's just Vivek put out data, right? He basically looked at order booking for shipbuilders, and we put this out, I think, yesterday. It's not as if there's been some huge accretion in orders or anything. And of course, execution is something we need to wait and watch out for. Let's just have the stocks up. Mazgaon, Garden Reach, and Cochin Shipyard. So 6.5% on Mazgaon. There is, what else? Garden Reach, which is up about 3.5%. And there is Cochin Shipyard, which is up about 8% or so as well. So this is just a one-way kind of a move that we are seeing there. The Nifty will come up as well for a quick look. So we are doing fine, given, of course, the circumstances overnight. It's not as if it's mattered for the last 2 or 3 days, and it doesn't today as well. We're up about 37 points. That's about just 0.25% or so, 19,764. Sanjeev Prasad is our man of the moment. He's Managing Director and Co-Head at Kotak Institutional Equities. He's joining us now to take some questions. Sanjeev, good to have you with us here. Thank you very much. I think, you guys today brought down Cochin Shipyard and targets there a notch. Talk to us about what's happening here in this space, in the shipbuilder space, with some data and some numbers, and what one should do here if one doesn't already have exposure. Go on.
That's not the shipbuilder space. Like anything to do with defense and the broader capital goods space has been on fire for the last 6 months now. Yes, there is a powerful investment theme which is building up. But now clearly the narrative is well ahead of the fundamentals. And some of the stock prices are very, very hard to now rationalize. I mean, we had a positive view on the Cochin shipyard, but the weight has gone up in the last 2 days. 20% up yesterday and another 7-8% up today. Clearly, I mean, how do you rationalize these things here? There is some expectation of second aircraft carrier order being given to Cochin shipyard, but looks like the market has assumed not only will the second one be given, but a third and a fourth, and God knows, what else. So everything is getting discounted so early, without any signs of any orders being given or any execution risk being factored in. It's very hard to even try and rationalize these things anymore.
And that's why the that's why the jokes come in. But anyway, Sanjeev, is the broader market also giving you sort of is it generally very expensive on a variety of matrices, or you think not really? What's your sense? Because there is a fair bit of debate on that one. We actually had a couple of fund managers with us day before yesterday. We had Tahir Badshah and Pankaj Tibrewal, and Tahir was saying, well, he wouldn't focus on indices themselves, but the economic cycle. So that kind of justifies what's going on. And Pankaj was on the other side. Just curious to know where you stand on this one.
Well, it depends on which part of the market you're looking at, to be honest with you. So if you look at the large cap indices, let's say BSE 30 or Nifty 50, I think can still make some case over there. Valuations are high, but they're not, crazy. Look at Nifty 50 on a 1 year forward index. It's 1 year forward multiple. It's about 19.9, which is not too bad in historical context. Look at the 5-7 years. It's still not looking that crazy. Of course, some of the individual names are on the higher side, and there are risks to business models emerging, which should result in derating over a period of time. But it's not as if you're in a bubble zone or anything over here. But if you look at the mid cap and the small cap indices, particularly as you go down the quality curve, the less known mid caps and lower quality small caps, that is where the real froth is. And that is where the excitement of the market is, I guess, at this point in time. You can see from the number of folios being opened in the mid cap and small cap funds, you can see the money which is going into all the mid cap and small cap funds entirely. Now, if you look at the flow data for mutual funds in the last 4 months, currently somewhere about 250 billion rupees has been put into equity mutual funds. And all the money has gone into mid cap and small cap funds. In fact, more than that, there is actually a money coming out of the large cap and the flexi cap funds. So that is the mood of the market. Given the performance of mid cap and small caps, there is now more money chasing the stocks. And given the liquidity of the stocks is not that high, obviously, many intend to buy results and prices going up, and that results in more money coming and now becoming a crazy upcycle. Obviously, there is a big disconnect between fundamentals and valuations in many of these names. I don't know what will break the cycle, but clearly there is a lot of discomfort with respect to valuations of many of the mid cap and small caps. I think the large cap names are probably a lot more, I would say, at least somewhat sensibly valued, compared to the madness we are seeing in the mid cap and small cap names now.
Sure. By the way, the market is picking up pace. Just look at that, going like a rocket as we speak. I mean, the Nifty is now almost at 19,800. And big moves coming into individual names. It's not just the Masgao docs of the world that's, gaining all the limelight. Look at transformers and rectifiers, 15% higher on that stock now. So big mover in the mid-cap space. You have a lot of these names like NMDC, NTPC, GAIL, Petronet, LNG that are all at fresh 52-week highs. So lots happening in the PSU arena as well. And then, names like DLF, Varroc Engineering, HCL Tech is at a fresh 52-week high. So that this market is sort of ablaze with a lot of ideas. Sanjeev, good morning and thanks for being with us. Where do you see the next pocket of growth come through? There's so much, right? As we were saying, anything and everything is rallying now. But where do your preferences lie?
From a market perspective, you're saying?
Yes, from like sectoral angle.
Well, I hope you don't lose too much capital by the end of, let's say, a year or so, because clearly we are in crazy zone as far as many of the mid caps and small caps are concerned. So I would try and preserve my capital to the best extent I can by being in the large cap names if I have to be necessarily invested in the market. And within the large caps, the places where you can at least make some case for valuation being reasonable are really the banking and financial services names, including insurance. Some of the healthcare pharma names are still looking reasonably okay, I would say. And beyond that, pockets of consumption names are okay, at least for the time being. But honestly, that's about it. Anything to do with capital goods is looking extremely expensive, whether it's large cap or mid cap. Anything which is to do with, let's say, real estate has now gone to somewhat uncomfortable levels. I would say again, you're fairly positive on housing cycle. You're clearly seeing a big housing cycle which has been in play in the last couple of years, and that should continue for the next several years. But the problem is in India, everything gets discounted so early, next 5 years, earnings get pulled up. So in that case, you could have a situation where, stock prices don't really fit for the next year or so. I don't see a big correction also. Looking at, the medium-term prospects of India seem to be very, very good. Given the status of other emerging markets, most emerging market investors would look at India more favorably even if there is a correction. So I don't see a big correction, at least in the large cap names. So that's my preferred segment for the time being.
Hi, Sanjeev. Good morning. You're clearly sounding a little bit more cautious then. In the last time we chatted, I quizzed you about what are you making of this promoter selling? You said, well, that's a hint, right? If promoters are selling. But it seems post, the last month and a half since the time we last spoke, promoters have sold even more. And all of that is getting lapped up. What's your comment on it? Are investors getting a good entry, or are promoters taking money off the table at the right time?
Well, there are investors clearly who don't want to take the hit, If promoters are selling and they are the biggest insiders, they know what is the fair value of the companies better than any of us will ever know, right? So if the PE guys, the promoters themselves are selling, that gives you a fairly good hint as to what is going on with respect to valuation in the market.
I guess, the way forward is that there are a lot of these sectors which were laggards that are coming back after a long while, right? I mean, you were talking about capital goods, there's infrastructure, there is defense. Defense has not done anything for last 10 years, and now suddenly in the last 2 years, it's come back in a big way. Sugar is coming back as well. So if you are a bit cautious at these levels on the mid-cap space, where do you still see some valuation headroom? Both in mid-caps as well as in large caps? Do you still like IT and pharma? Because IT has come back as well.
Not really, Sonia. If you look at the bottom of valuations across the board, there isn't much value left in the market, barring, as I was saying earlier, the banking and financial services space, pockets of pharma, healthcare, and consumption. But that's about it. Either stocks are fairly valued, which is probably the case for the IT services companies, or they are expensively valued currently. And then you have many of the mid-cap and small-cap stocks, so we don't even get started on those. There's no point in talking about things we really can't comprehend anymore. Like going to a movie, trying to understand the movie when it's a different language, compared to your natural language. Can't understand anything. So after some time, you just stop, applying your mind and start enjoying the movie. Whatever is going on, you enjoy the fun.
Across your coverage universe, Sanjeev, how many buys do you have now?
I will have to look at it, but 1 second, hold on if you want to.
I mean, just to get a broad sense, I mean, is it 25% of the names? Is it
more buys than sells?
Hold on 1 minute. We have about 28% of our universe is still a buy.
Okay.
And about 58% is that. So we have about 45% of our universe as reduce or sell now, which is roughly half the coverage.
Okay. Just one more question on a specific space. This is the EMS space, Dixon and Amber and Keynes and Sirma, etc. Again, what's the call here? It's an opportunity, absolutely, no doubt about it. Electronics are the second biggest import for India, and we start to make a lot of it here. So the road is a long one. But the question is whether one can buy these now at where they're trading. Go on.
If you do a reverse valuation of these companies and the initial coverage on Dixon, yes, there is a long runway of growth, but if you just do a reverse valuation, the kind of numbers which have been thrown up in the outer years is like staggering. In case of Dixon, for example, the company should have, something like 50 to 70% market share in many of its, current lines of businesses. That is obviously not going to happen, unless and until we are completely underestimating our growth, but we have been very generous in our growth assumptions. We are very generous in our profit assumptions. Even then, the market share being implied by the current stock price, 10, 20 years down the line is so high, it just doesn't make any sense, to be honest with you. But yeah, the next 3 years, 5 years growth will be fairly strong. So I guess that's what the market is focused on as of now. And forget 3 years, I guess the market is more focused on next 3 months for now.
Oh, absolutely. Fair point, Sanjeev. Actually, we in a little bit from now, we have the management of Dixon joining us. If you're interested, you can listen in. But thank you so much for joining us and running us through your perspective. Always interesting to speak with you, Sanjeev. Well, RBI has approved a 2-month term for Deepak Gupta as the interim managing director and CEO of Kotak Mahindra Bank. My colleague Abhishek is joining in with the news and what could be the way to look at this one. Abhishek, morning.
Morning, Prashant. So as you mentioned, RBI has given 2 months time frame or 2 months period to Mr. Deepak Gupta to be the interim MD and CEO of Kotak Mahindra Bank. Now, Kotak Mahindra Bank had mentioned earlier that they have given the candidate's name for MD and CEO position of the bank to RBI in early September that they had mentioned to us. In the press release, they had also mentioned, earlier that they have made Mr. Deepak Gupta the interim MD and CEO of the bank till his retirement, that is 31st of December 2023. So this has been, cut short in terms of RBI giving the approval. In all likelihood, RBI may be close to finalizing or may have finalized the candidate for the post of MD and CEO of Kotak Mahindra Bank. Back to you.
Okay, thanks a lot for that. Very helpful there. But let's move on and talk about Dixon Technologies. It's definitely in focus. The stock has surged more than 75% in the last 6 months. Do note the government has received 32 applications for its IT hardware PLI scheme, and there are a lot of brokerage notes that have come out as well that are very, very optimistic on this entire space. In fact, in the last 6 months, the stock is up about 70-odd%. CLSA put out a note where they have an outperform rating with a target at 5,675. So despite the big up move, CLSA is very optimistic on this space. Saurabh Gupta, the Chief Financial Officer at Dixon Technologies, joins us now to talk about that. Saurabh, thanks a lot for joining in. I want to start by asking you about the EMS industry on the whole, because CLSA put out a note where they said that they expect this industry to deliver a 22% revenue compounded growth over the next decade. Are you as optimistic as them? Do you think that this could be the growth run rate? And also, you were a successful applicant in this PLI scheme. So what is the kind of incremental capex and revenues that you're looking at?
Yeah, good morning, Sonia. Yeah, so we are also of the same conviction, Sonia, that it's a large opportunity that we are sitting on. And that's the reason we are putting up more investments, expanding our capacities. If you see the CLSA report, clearly they pointed out that India's share in global electronic space is just 2%. And by 2030, it should be higher single digits. And we're talking about a 20% market share by FY40, financial year 40. So clearly, if you look at today, China is the leader there with a 45% share. But now all those things which happened in China, I think so because of the strong policy framework in India, because of the low labor costs, because of abundance of talent pool in India, and clearly the global geopolitical tension, the supply chains are shifting, and we are sitting on a large opportunity. So we have the same conviction that is being reflected in the CLSA report.
Got it. Also on the PLI scheme, you've been a successful applicant. I just want to understand what is the kind of capex that you're putting on board for this? What is the kind of revenue potential? And you spoke about how, in general, India has just 2% of the electronic market, globally. As this pie grows, how much of a beneficiary could you be? So on both on the capex and the revenue opportunity?
Yeah, so coming specifically to this IT application, where the government has received 32 applications, and of course we have applied in the larger category. So we have committed a capex of 250 odd crores, that is in the hybrid category for domestic companies. We have committed a revenues of 48,000 odd crores under the application over a period of 6 years, starting next financial year. We have committed to the local value addition, the deepening of manufacturing as the PLI has been structured. So we think that there will be a large opportunity for localizing a lot of components in this category. So clearly after mobiles, I think so, where we have acquired some large customers lately, I think so IT hardware will be a next trigger for our growth going forward.
All right. Hi, Saurav. Good morning. Well, you have partnered with Acer. Do you still have any order book with them? And also, do you see other clients coming on board soon?
Yeah, so Nigel, Acer definitely has been, we have been working with Acer for the last 18 months. And clearly the order book with Acer will increase now significantly because of this IT hardware PLI and also government putting restriction on the import of laptops and tablets. And secondly, we are in the final stages of closing our partnership with a very large account, which has a very large market share both globally and in India, and we'll be announcing that very shortly. And that's the reason we have a very strong conviction in the revenues that we have applied in the application.
How fast and which is this global client you're looking at? And how soon can we hear about it?
It will be very soon, Nigel. I think so. In the next 1 month or so, you'll have the name on it.
Saurabh, hi, good morning. This is for laptops.
This for laptops and tablets, yeah.
Laptops and tablets. Okay, so could be Dell, could be HP. One of the two. You can give us that much.
I'm not giving the name right now, but clearly we'll have the name in the next 1 month. Yeah.
Is Prashant getting it, in the vicinity?
So clearly, I'm the top 3 brands globally. So yeah, but you can ask those.
Top 3. Which one are we missing? Dell, HP, which is the third one?
Saurav will help us.
But what about an order from Jio Bharat? You secured that order, I think. What is the progress on that? What's the quantum of the order? And will it only be on the phones?
Yeah, so the Jio Bharat phone has met with an initial success, I think so. They have come out with an attractive pricing. So clearly, there's a big 2G market that they are ready to grab. And we have got an order book of almost 2 crore mobile phones from them, I think so, which should get executed by March, April next calendar year. And then depending on the further success, we can get repeat orders. But clearly, yeah, initial success has been very good.
So 2 crore phones would be how much? What would the quantum be? Is it, are we looking at about 1,500 crores?
Around 1,800 odd crores. Yeah, around 1,600 to 1,800.
Okay, 1,600 to 1,800 odd crores. Executable by when, you said?
By March, April next financial year. So starting now till March, April next calendar year.
And would this be also, I mean, apart from the 1,600, 1,800 crores, would you also be looking to get orders on the laptops, the Jio laptops?
So it's very preliminary right now, but we haven't had any kind of discussion so far. But yeah, hopefully we have a strong relationship with Jio on the mobile side. So hopefully we will work on that side.
Okay, all right. Saurav, on the mobile segment itself, that's going to be the big growth driver, right, from here on. You were supposed to see traction start from, say, September for ITEL smartphones at approximately, I think, 1 million per month. And also Xiaomi, that was expected from October, another million or so. What's the progress for here? And is this going according to plan? Give us on a monthly basis, what could that number be for both these two large companies?
Yeah, so Nigel, clearly mobile is the largest trigger for our growth. So not only our order book with existing customers like Motorola, as well as Nokia is increasing. So Nokia and Motorola will have an increasing share of export markets. Xiaomi, as you mentioned, I think so will start executing from October. And clearly, over a period of time, it can become a large opportunity for us because they're clearly a 20% market share Indian market. Again, with ITEL, we've got order book both on the feature phones and smartphone side, and then the Jio Bharat phone. So clearly, mobile will be a very large opportunity. I don't want to pinpoint a number, but it will be a very large number this year and definitely an even larger number next year.
Saurabh, is there no way to break into the Apple supply chain at all? I mean, the one way we had that here in India was the Wistron plan, which Tatas are taking over. But I mean, for you, is there any way to get into that?
Yeah, so Apple is definitely deeply committed to India. They have said that by 2026, they want to source 20% of their global requirements from India. And because of the geopolitical tension and recently the ban by China in the government for Apple phones, so clearly that is a positive for India. My sense is Apple has continuously diversified its vendors, starting with Foxconn, Pegatron, Wistron, then Luxshare, India, now Tata. So clearly, we will definitely work towards getting Apple also on board. But yeah, as of now, there's nothing in the pipeline.
Because typically, the 40, 45 odd suppliers that Apple has in China, when Apple moves, they try and kind of create that ecosystem with the same companies. But is that could that change? I mean, is there what could be the way in? Is it could we expect something? Are you working on it?
So what I can clearly say, what you mentioned right now, clearly they want to shift 13, 14 suppliers, which they have given the list to the government as well, where they will encourage those component suppliers to come into India. My sense is for us also, Dixon, the way for growth for us is a lot of partnerships and JVs in component ecosystem. So we will definitely work towards it if Apple gives us a chance. But definitely, as of now, I can't comment anything more than that. Yeah.
Just one more question on the laptop bit, right? The global sort of tie-up that you will announce. Will this one of the big three help you set up this capacity? Will they co-invest along with you for this production line?
No, we will be making the entire investments of 250 crores over a period of 6 years. That will be both on the panel manufacturing as well as backward integration, because that's being structured under the PLI. And clearly, yeah, in the next 6 to 8 months, we look to set up these capacities, and there'll be a ramp up and stabilization phase. Yeah, but by next financial year, I think so we'll start showing the revenues.
I remember the third name, Lenovo. Is that correct? HP, Dell, Lenovo, right? Those are the big three. That much you can say.
Yeah, those are big three, right?
All right. Well, just leave us with some numbers on what the next couple of years would look like on the top line, right? You're sitting on a base of about 12,000, 13,000 crores of revenues in FY23, which was a growth of 15%. Where do you see your revenues go to in FY24, FY25? What kind of reasonable top line growth are we looking at?
So Sonia, we have really acquired large customers in mobile category and also in other categories. Clearly, we are sitting on a very large opportunity, and both IT hardware and mobiles will be the largest triggers for our growth. So we can clearly say that we'll have aggressive growth starting H2 of this financial year and even bigger growth in next financial year. I don't want to pinpoint a number, but it will be significantly larger than the industry growth, both industry as such, electronic industry, and also the EMS industry.
All right, so our final question, on the top line, you're not giving us too much of color, but maybe by the end of this quarter, we'll get further details with regard to your guidance for this year. But on the margin parameter, I wanted to ask you, since your mobile division is going to lead growth, I think last year it was around 5,300 crores. This year, I guess it goes up drastically, and from there on as well, it moves up. So if you could tell us, how do you see the mobile segment growing from on a base of around 5,000 crores, point number one. And for the overall scheme of things, want to dilute margins? Is there a risk to that 4.5% margins since mobile is going to lead the way?
Yeah, so Nigel, clearly you are right. The mobile is a lower margin business for us, both in terms of gross margins and EBITDA margins. But clearly, if you look at the margin levers for us, one is that we think the operating leverage benefit has played out in certain verticals. It will play out in more verticals. We are continuously migrating more and more to our own design solutions. And clearly now, from here onwards, we'll focus more and more on creating a large component ecosystem to a lot of partnerships. So those will help in those will help in driving the margins. But yet, yes, mobiles and IT hardware will be lower. But we still hope, and we still are confident that I think so 4 to 4.2% margins should be achievable for next couple of years.
Okay, we will let you go on that note. All the best. 4 to 4.2% margins achievable for the next couple of years. Got that. And all the best for your new orders, all the new segments that you're getting into. We hope you continue to thrive. That's Dixon Technology, by the way, has been a big mover back at 5,100, 75% rally in the last 6 months. Another company on our radar is Angel One. We'll talk about that. Prabhakar Tiwari of Angel One will join in to discuss the business update for the month of August. Stay tuned.
Okay, welcome back. This is Corporate Radar. The market's doing just fine. We've got decent gains coming through on the Nifty, 0.25% once again. Slow and steady, and then, it's slow in the first half and then usually picks up in the second half. That's been the experience the last 2 or 3 days. And this is just the first hour, within the first hour that we are in. So 19,775 on the index. Now, broking firm Angel One is in focus. They saw a decent rise in a client base in the month of August. Total client base improved by 4.5%. Gross client acquisition zoomed by 19% on a month-on-month basis. Let's talk about this and more. We've got the management of the company joining us. Prabhakar Tiwari is Chief Growth Officer at the company. Prabhakar, good morning. Good to have you with us here. I mean, I guess for brokers, there can't be a better growth environment, right? In terms of demat accounts, I think when we'll put this out later, 10 crore demat accounts. So it's been on the up and up. But let's drill down to your business. For you, when I look at the last numbers, gross client additions have hit a new high, but your overall market share has remained absolutely flat month on month. Could you tell us why is that so?
Yeah, so good morning. Yes, that's a great time. A lot of points in the market. In terms of market share, I think these are like temporary phenomena. I believe we already are on a high market share. And if you look at it on a commodity, we have gained by 82 BPS. And on cash also, we are making a lot of movement. So in coming months, you will see a lot of action here from our side.
Okay. When you talk about action, can you tell us the gross client additions, right? I mean, in this quarter gone by, it hit new highs. In August, the gross client acquisitions was at 7.3 lakhs, which is a growth of around 46% year on year. On this base of 7.3 lakhs, how much do you think you can take it up by over the next couple of months? What's the average growth that you're looking at?
Okay, just one correction. It's a 65% growth year on year. My team will feel bad about that lesser number, but fundamentally, I mean, a lot of good work is being done. Our super app product strategy is working. Our NPS has gone up by 2x in last 6 months. And our direct mutual fund business, you could already see as 2.4 lakh unique SIP. So a lot of new people are coming who are SIP only or SIP first customer. And we are committed to increase our organic business by 5x this year. So I would expect that, we'll have similar growth momentum going forward. The rest will depend on how we execute and how the market environment is.
All right. Hi, Mr. Tiwari. Good morning. What about the order book, the order run rate per day, trading day? I think it's around 5.2 million approximately. I think that's been more or less constant. Are you seeing any kind of signs of slowdown? Do you expect to continue at this sort of a run rate?
Yeah, that's possible because see, what happens is that, once you focus on being a transaction platform and you focus on the important product features and you keep on your new feature addition velocity, eventually the ease of transacting your platform will go up. And many of the customers operate from 2-3 different apps, and for different segments or for different reasons. So when they see that one single app fulfills a lot of their requirement and is able to give them a great experience, they ship their order volumes to that platform. So we believe with a super app in place, we will see traction there going forward.
Prabhakar, with this change in expiry days, right? We got an expiry happening pretty much every day of the week now. As you see it, is this going to lead to significantly higher volumes or your thoughts on that? One. And second, my colleague Yash was picked up from sources and that SEBI is now working on 1 hour settlement, right? I mean, that's the aim. T+3, T+2, T+1, now almost instantaneous settlement. If that were to start to happen, what's your assessment? I mean, what will that do to volumes?
See, I mean, if you look at it, there are financial products for a reason, and they have a role to play in the market, in terms of market building and a lot of other such things. And expiry dates are decided basis a lot of consideration. And because we want to, there are customers for such financial products. So in my opinion, everyday expiry, will be helpful. There could be an impact, but eventually it depends on, which segment of market get impacted. If there is a net positive or it's a zero-sum game, like, some of the expiries will impact other expiry volumes. That is very tough to kind of comment right now. But fundamentally, given the
Sure.
fact that we are becoming more mature market, this should be good.
What about the settlement bit?
That should be good, and kudos to our regulator. They have been very forward-looking. They have been increasing liquidity in the market, and we welcome it. We are prepared, like rest of the industry, to support whatever new guidelines which come in this area.
Okay. Mr. Tiwari, the client base, the incremental client base for Angel One is coming in largely from tier 3 cities with a median age of 29 years. So that's a very interesting take, right? How there's this rising urban middle class and how there is a lot of financial inclusion happening over here, as we were talking about the 10 crore demat accounts. Can you tell us what is your client acquisition strategy? How do you plan to target this whole millennial Gen Z piece? And what kind of growth are you looking at here?
See, we have a very well diversified channels in place. In paid performance marketing, we have an engine which is very, very efficient, very state of the art. We have a huge referral channel. We have been increasing our organic channel. This year, we want to take it up by 5x. We have an assisted channel through B2B, and we have a DRA channel in place. See, fundamentally, this entire acquisition strategy depends on how you can reach to inaccessible pockets of the market and can you acquire customer profitably from there. Because if you look at it from the customer angle, this is organizational angle. If you look at it from the customer angle, they have no way of accessing the market, other than their smartphone. And, companies like us who make the smartphone app where it's intuitive journey, it's like secure journey, it's a speedy journey. Eventually, they will choose us over others. And that's how I see us growing in future also. More importantly, we are increasing our brand marketing investment unlike last year. So there will be a 6 to 10x increase in our brand marketing spend. We have recently launched a super app campaign. Some portion of the attribution for last month high numbers could be given to that campaign also. And in coming months also, we'll be spending a lot on brand marketing. And this will help us manage our growth momentum and also to reach out to this tier 2, tier 3, tier 4 audience, which are looking for smart solutions.
Correct. Mr. Tiwari, in quarter one, the cost to net income, that inched up, I think, to around 52.5% odd. That was due to higher employee cost. What's the sustainable trend from here on, cost to income?
See, I won't be able to give any forward guidance number on that, but let me tell you that we are growing as an organization. We'll be getting into lending business before the end of the year, and we will be getting into AMC business very soon. And we are hiring a lot of new people in the management. We have Mr. Nishant Jain, who has joined us as a Chief Business Officer for our assisted business. And we have Mr. Ravish, who has joined us as a CPTO. So it will be not right to look at our cost to income ratio from the angle of existing business. You also need to understand, the kind of more diversified business we're trying to build.
Okay. All right. Thanks a lot for joining in and all the best. That's Angel One with, their Q1 numbers and the way forward for the company. By the way, for the market, we are not too bad, actually. We've seen a growth of almost about 40 odd points today and the Nifty holding on to 19,780. Let's get you a CNBC-TV18 exclusive. We learned from sources that PB Fintech wants to become a reinsurer. Yash Jain has all the details for us. Yash, what are you picking up?
Well, Sonia, in the last 1 year, whatever we've spoken about PB Fintech, of course, we've spoken about the improving profitability and business, but we've also largely spoken about the headwinds which the company faces, be it in the form of a parallel insurance aggregation platform from the regulator in the form of Bima Sugam, or, companies looking at more and more direct sales. It is because of this headwinds that the company essentially needed an alternate business channel, largely to diversify its business and raise more revenue streams. What we've been given to understand from our sources is that PB Fintech has started exploring options to get those new revenue streams into its business. What we've been told by our sources is that the company, from an insurance aggregation platform, is now looking to enter the insurance manufacturing space. Insurance manufacturing space is nothing but when you have your own life or general insurance or health insurance products. Also, what sources tell us is that PB Fintech intends to start or enter the insurance manufacturing space, firstly from the business to business market. That will be reinsurance, that is reinsuring the insurance company's products, and then eventually looking at general insurance market and later on life insurance market. As far as the general insurance foray is concerned, what we've been told is that the company has had a few informal conversations with the regulator to understand the space, to understand what would be the foray into this particular market. Also, it has sort of onboarded legal consultants to help the company prepare for this big foray. As I said, the company currently is into insurance aggregation where these products are listed on the platform, and now with all these headwinds coming in that business, the competition intensity increasing, is also looking at insurance manufacturing to start with the reinsurance business, later on also look at general insurance and life insurance market. We've written to PB Fintech on this particular development. A response from the company is still awaited.
That's a big story, important story. PB Fintech, I mean, that'll, if they do this, this will change the face of the company. Yash, stay with us because we have Madhukar Lada, of Nuvama Institutional Equities, who tracks the sector as well. So if you want to join in for a question or two. Madhukar, good to have you with us here. You heard my colleague Yash detail that story out. PB Fintech not happy with just being a distributor, aggregator, but wants to get into the business for themselves. What do you make of it?
Line or call it.
Okay, I think right at the moment we lost that time, but we'll have him back. Yes, just a quick one if you're still there. This is very preliminary, right? I mean, and the discussions with the regulator have been at a very early stage. What does that mean? I mean, are they asking whether we should apply? Or is the application process already underway? Go on.
Correct. So you very rightly pointed out it's at a very early stage and the conversations with the regulator sort of revolve around the fact that they are an insurance aggregator platform. Is there any conflict of interest that comes in the way, or if that way is cleared for them? Also, the insurance regulator made certain amendments to the reinsurance market very recently, reducing the minimum capital required to start the business from 100 crore to 50 crore. Of course, changing the order of preference as far as the sector is concerned. So understanding all those nuances from the regulator, how does it benefit the company, in what way does it benefit the company? Also, one point which I missed earlier is that it wants to, at this point of time, the intention so far is to start this reinsurance business by itself, which is not to have any partner in the company initially and start this business by itself. It has cash on its books to sort of deploy as far as the gestation period is concerned, and then later on when the business reaches a particular stage, then sort of look at getting a foreign partner or an Indian partner as far as the business is concerned. But initial conversations with the regulator to understand the space, to understand the recent changes which the regulator has made, to understand any sort of conflict of interest for a better entry to the foray.
Okay, Madhukar is with us of Nuvama. He tracks the space. Madhukar, what do you make of the story?
Hi, good morning. So,
good morning.
I think, PB obviously has a lot of data available to it in terms of, what sort of customers profiles are, their demand is. And I think they can also help in designing of products. So over here, I think what they'll try to do is make more white label products with insurers and have basically provide insurers with reinsurance capacity behind the scene, right? And rather than spending a lot more on going directly to the consumer, the cost in this business will be limited because you're not spending that much on branding, marketing, etc. And you get some portion of the risk and some profit of that risk that you take, while as you sort of underwrite that business and you provide some reinsurance support to your general insurance partners.
Okay.
And
Madhukar, you don't see any? There's no conflict of interest, right? I mean, they can be an insurer and then kind of distribute the products as well, right? I mean, it's not as if on their platform they have all insurance companies. I think they don't have one or two big ones.
I don't see a big conflict of interest over here.
Okay.
because they can be a distributor and a reinsurer.
Sure. And does it say anything about their existing aggregation business, that they feel the aggregation business, because of Bima Sugam, etc., is under threat, so they need to sort of move into this? Is that one way to look at it, or not really?
Not really. I think it's just a case of in forward-backward integration into the insurance space. And I think on the new business side, PB reported strong growth even in the last quarter. And my sense is Bima Sugam is still some time away, and insurance is still a very push product. So I would not read too much into Bima Sugam at this point in time.
Hello, Madhukar. This is Yash here. Thank you for taking the question. My question to you is essentially, not on the conflict of interest, but as far as the current business is concerned. There are life and general and health insurance products which are listed from various companies. Let's look at the scenario where PB Fintech looks at becoming a manufacturer in the general insurance business or life. Not conflict of interest, but does that sort of impact the current aggregation business? Do you see a threat of these life general insurance companies coming forward and saying that, listen, we are on your platform, you have your own product on the same platform, there could be a preference, there could not be a preference. Do you see that sort of conflict coming in from the existing players on the business and impacting the existing business?
That is a possibility if you become a direct sort of manufacturer and a B2C sort of player for general and life insurance. That is definitely a possibility because, you will have access to a lot of these platforms and products and sales numbers, those sort of things. So other companies may not like it that much. But as far as the reinsurance business is concerned, I don't see that being a problem.
Okay. All right. Madhukar, it's a pleasure. Thank you very much for joining us with those inputs. Yash, thank you for joining us with that story. It's an interesting one. Changes the profile of the company from an aggregation platform, as we all know it. Policy Bazaar, of course, synonymous with a platform which aggregates these policies and products. Thanks very much. We'll take a very quick commercial break here. On the other side, we shift our focus to the commodity segment. Manisha is going to be joining us with exactly that. Stay with us. Back, we've got the market, which is up about 0.25%, 1/3% or so, looking good. Mitesh is with us with what you should be doing now on the Nifty and then individual stocks. Mitesh, hi, morning.
Yeah, Prashant. So I think on the back Nifty, around 45,000, taken some profits off, trailed the stop loss now to at 44,770 odd levels. And once we start getting past 45,050, then the bank Nifty could even head towards 45,320. But as I said, there's a news flow hanging over it, so let's see. And on the stock side, I have a buy on Bajaj Finserv, which has given a good breakout today. So that's a buy with a stop at about 1535 for targets of 1600. And the other one which I like is Chola Finance, which I would recommend buying with a stop below 1134 for targets of 1190.
All right, Mitesh, thanks a lot for that. Well, let's do one thing. Let's also get a quick handle on what's happening in the world of commodities this morning. Manisha is joining in. Manisha, what's the one commodity that you're tracking today?
Well, I'm looking at the silver prices because they have been very, very volatile in the last few days, and silver clearly seems to be underperforming the metal space. It's slightly confused with silver, because it's part precious metal, part industrial metal as well. The kind of demand that industrial metal from the industrial side that the silver sees also seems to be stalling a bit. So while we have seen all metals decline for this week, silver has fallen by 6%. And when you look at the year-on-year basis, we still are 24% on the higher side, though. This is what silver has done in 2023 until now. We started the year positive at $23.9 per ounce. We saw a sharp decline in the month of March below $20. 26.10 has been the high for silver for this year, and currently we are trading at $23 an ounce. Also, let me tell you on what silver has done in sense of range in last 3 or 4 years. So when you look at the charts from 2020 onwards, we've seen silver prices hit a high of 28.5 and a low of 12.5. So clearly has been a very big range for the last 3 years itself when it comes to silver prices there. Also, when you look at an all-time high for silver, that was in 2011 at $48 an ounce. So trading at 23 right now, we are half of what silver perhaps is capable of if we see all of that industrial demand do come into the markets there. Talking about that, this is what we've done in sense of industrial demand in the last year at 556 million ounces. And for this year, the anticipation is that we could be hitting a 550 million ounces as well. For silver, the strength also comes in from the fact that this is going to be a third straight year that you are looking at a global deficit, and that too at record levels. This is the forecast for 2023 for silver going forward. So World Bank, Bank of America and Trading Economics all believe that $21 to $23 an ounce is where the silver prices perhaps could average. There is bullish cues though coming in from Citi and Investing Heaven, which also believe that $30 an ounce on the higher side could also be crossed. There are, of course, some ifs and buts here in sense of dollar index, Chinese demand, etc., and that would move the prices going forward.
Okay, thanks a lot for that. Well, I'm also looking out for some stocks. So let's pick them up. Landmark Cars, the stock is up almost 6% today. And if you pull up Landmark Cars in the past 6 months, the stock has seen a big rally. It's up almost about 40% in the past 6 months. Now, it's signed a letter of intent with Mahindra & Mahindra for opening new dealerships in West Bengal in the Howrah region. And the dealerships will engage in their key business, which is the sales, after sales of all of Mahindra's brands, their personal vehicles, the pickups and the Supro range of vehicles as well. So it's additional business for Landmark Cars, signing up of new dealerships, especially for Mahindra's personal vehicles, which will be in the which are the new products that Mahindra has launched. So good business for them coming through, and big move in the stock as well, up almost about 40% in the last 6 months. Let's slip into a quick break. On the other side, our special segment, It's the Economy, will put focus on whether the RBI will end or continue the incremental CRR. Lata will be speaking with Samiran Chakraborty of Citi and A. Prasanna of ISEC PD on what the RBI might do. Stay tuned.
Today on It's the Economy, the discussion is obvious. What will Reserve Bank do to the incremental CRR of 10%? Remember, on August 10th, Reserve Bank imposed this additional 10% CRR on all deposits that banks collected between May 19 and July 28. The RBI's argument was this was to mop up the extra liquidity created by the return of the 2,000 rupee notes. The return of the 2,000 rupee notes was announced on May 19th. Now, the central bank also promised to review this incremental CRR on or before September 8th. We were actually widely expecting the Reserve Bank could have already announced this decision by now. And even as we speak, we have one eye on the RBI website. With that, Professor, let me invite my guests, Samiran Chakrabarti, the Chief Economist at Citi India, and A. Prasanna, Senior Economist at ICICI Securities PD. Gentlemen, thank you very much indeed for joining me. Just a little bit of a preview for those who really don't care for this acronym, CRR. A cash reserve ratio is a bit of a punishment for banks. When you impose a cash reserve ratio on any amount of money or on deposits, what RBI tells the banks is you are raising those deposits at 5% or 6%, but you cannot lend it, that amount of money. You have to keep it as cash with the Reserve Bank. So banks lose. A CRR is a punishment for the banks to that extent. But for the macroeconomy, it may be needed if there is too much money chasing goods and therefore prices are rising. High inflationary situations call for a CRR hike. With that, Samiran and Prasanna, thank you for waiting. Samiran, you believe that Reserve Bank will continue with the ICRR in some form. Why would you say that?
Thanks, Lata. I think the way we are looking at it is that the early part of September, we had liquidity surplus, the banking system frictional liquidity surplus of about 1.5 lakh crores. And historically, we have seen that at the peak of the deficit, the liquidity drained during the month of September is about 2.5 lakh crore. So if we start the year with about 1.5 lakh crore at the peak liquidity deficit, it would be about a 1 lakh crore deficit if RBI does not change the ICRR. Now, the question is that for those 3-4 days of peak liquidity deficit, can RBI manage that through something like the variable repo rate auctions and infuse liquidity? Because our sense is that once this period of liquidity tightness gets over in the middle of the month, then again by the end of the month, liquidity will be significantly in surplus. We think durable liquidity by end of September would be more than 2 lakh crores. And in an environment where inflation is still a bit of a question mark that how quickly this is going to come down below RBI's comfort level, slightly tighter leash on liquidity probably seems to be the best path. Having said all this, we understand that there are many ways to skin the cat. You can reduce liquidity in a multiple ways. So it need not be that only ICRR can be used. There are other tools at RBI's disposal also. But our short story is that RBI might want to keep liquidity a bit tighter and overnight rates a little bit more elevated given the inflationary backdrop that we are in.
Okay. Prasanna, is there an argument for removal or reduction of the ICRR? When the worst of inflation was 7.44 and we saw veggie prices declining thereafter. And as Samiran says, there is a withdrawal of cash also during Diwali, during the festival season. So can there be good reasons to reduce or remove the incremental CRR?
Yeah, so first of all, I think if we link to the CRR move to current inflation, probably it helps the optics. Maybe RBI can say that they're taking some steps, but frankly, if it's a food inflation driven spike and then you're doing CRR to withdraw liquidity, how does it help? I don't understand. I think it's pure optics. So maybe we shouldn't kind of focus too much on that. I think in general, what has happened is that I think compared to where we were at the start of the financial year when RBI decided to pause I think the monetary and liquidity and the financing conditions have been easier than what both the RBI and the market kind of anticipated at the start of the year. I think one is obviously the 2,000 rupee note recall. Other is, I think, even in the first 3 or even 4 months of this fiscal year, I think the FX situation was quite benign, and therefore RBI did add liquidity or inject liquidity by purchase of forex. And of course, now that situation has changed. So I think there's a lot of unanticipated liquidity buildup, and I see this ICRR as a way to kind of suck that out till a natural liquidity drain takes over. And like you said, yes, that drain will happen in the run up to the festive season, in the run up to Diwali, basically. So essentially, if you look at Q3, that's when I think the currency demand, the currency leakage should really pick up and the natural drain should happen. Side by side, it does look like on the FX side also, because the dollar is strengthening and of course, crude prices have gone up. So obviously, rupee is under pressure. So when RBI kind of intervenes to stem the volatility, there will be some liquidity drain through that route also. So I think the way the RBI will do it or should do it is this ICRR is basically a tool which they can use to calibrate this process. So maybe right now they might want to reduce. 10% seems a bit high because we are going into advanced tax, and then by October anyway, the cash withdrawal will also start taking place. So maybe they can reduce it to something like a 5%. And I think the way to do it is to reassure market. Maybe RBI can say that they will review it every fortnight. Of course, that gives the impression it's a temporary instrument. But to be fair, it has to be a temporary instrument. I don't see this instrument continuing beyond November, for example. I think maybe it can continue through October. And by November, I think the peak currency demand will be in place. A lot of liquidity drain would have happened. So maybe at some point in November, RBI can remove it completely. So in that sense, it's a temporary instrument. So they can say that they will review it every fortnight. And then the percentage, obviously, they can calibrate as they see fit.
Okay, fair enough. So both of you agree that the banking system liquidity anyway moves into deficit by the end of this calendar. Like, as both of you say, maybe in November itself. So it's a question of managing for what is left of September and October. Now, Samiran, there is another argument that bankers were advancing. RBI would perhaps have liked to remove the liquidity by the VRRR. For those of you who are, again, an ugly acronym, variable rate reverse repo. RBI normally gives it, these days it has been giving it for 15 days. And bankers have not preferred that 15 days because it's uncertainty. You may need the money before 15 days, so you don't put the money there. And therefore, the VRRs have usually flopped. But, Samiran, the argument now is bankers, first of all, the new VRR that has been announced for today is only 50,000 crore. It's not a big ask. It's a slightly smaller ask. And from the bankers' side, if you don't apply for this VRR, then I'm going to punish you with a bigger ICRR. So bankers would say, oh my God, I'm losing more money ICRR. I might as well give RBI the money in VRRR. Therefore, RBI may announce the decision at maybe 11:30, 12 when they know the results of that VRRR auction. You think that makes sense? RBI is trying to lead the banks into using the VRRR to drain out liquidity. Otherwise, it has to use a much more punishing instrument. What say?
So, Lata, it's difficult for me to speculate on what is the RBI's thought process behind introducing ICRR beyond what they have already mentioned. But if I just look at the revealed preference or the revealed data, then what it shows is that pre-ICRR, if you look at the ratio of what's the amount that RBI offered in VRRR versus what the bank's participation rate, then that ratio was relatively higher. After the ICRR introduction, that ratio has actually fallen. Now, for the month of August, the ratio has been mostly in the 30% range, which does not indicate that if the objective was to push banks into participating more in VRRR, that objective has been met. Now, having said that, this analysis is slightly difficult because the RBI did not reduce the quantum of total VRRR announcement in August, despite liquidity becoming tighter because of ICRR. Now, today's auction, which is on a lower quantum, maybe that will indicate better whether this ratio is changing, whether banks are actually participating more or not.
Okay. So the market is just shifting its expectation. First it was morning and now the expectation is that it will probably be midday when the results of the auction are known. And if the expectation of some of these bankers whom I spoke to is that it will be well bid, that RBI will get the entire 50,000 crore, that will give them the confidence that yes, bankers will respond to the VRRR auctions. They don't have to use a punishing instrument like ICRR. And the next auction could be a 5-day, could be a 7-day VRRR, not 14 days. But Prasanna, you know, there are other things which is indicating that RBI is looking at other instruments. I am given to understand again from market sources that they have done at least $5 billion of sell-buy swaps. Now, that means they have sold dollars now, which means they take out liquidity, and that swap matures around September 15th, when the market is in deficit and therefore the liquidity comes back. Going by this behavior, the intervention in the FX markets to sell dollars and therefore remove liquidity, do you think it is safe to expect Reserve Bank may remove or reduce ICRR and use FX as an instrument?
I think it's, I mean, like Samiran said, I think it's difficult to speculate with all this information. The point is, anyway, I think FX intervention, RBI does it for, or rather to kind of manage the FX market, right? So that is the primary purpose. Obviously, the liquidity impact is a byproduct. So I will be very, very surprised if they are kind of designing or doing their FX intervention with completely a liquidity objective. So I mean, I am not sure whether this kind of, these things add up. So I think different instruments for different objectives, I think probably you should live with that. And anyway, I think the volatility or rather the volatility in global FX markets is quite high right now. So I would be very surprised if RBI is trying to do this kind of liquidity management through FX, because I think they will have their hands full managing FX itself.
Oh yes, of course. We are seeing new highs in the dollar index, 6-month highs. And RBI has repeatedly said that they don't mix the two, one instrument for one objective. And by the way, for the benefit of viewers, and Prasanna, you may not have read this, Samiran's report quotes two very important quotes from the Reserve Bank documents to prove that Reserve Bank always links liquidity with inflation. One quote is from the RBI's Currency and Finance report, where they say if surplus liquidity persists at above 1.5% of NDTL, I think maybe the quote should run so that others can read it. If surplus liquidity persists at or above 1.5 percentage point of NDTL, for every percentage point increase in surplus liquidity, the average inflation could rise by 60 basis points in a year. So Reserve Bank clearly is saying if there is more liquidity, then they have noticed that there is a rise in inflation. There is another quote that was there in the August bulletin, which Samiran points out. RBI has, okay, I'll just come to that. The slosh of liquidity also has implications for financial stability in the form of potential asset price bubbles and weakening of lending standards, end of quote. So clearly RBI is making that connection. Samiran, since both of you agree that liquidity is anyway getting into a deficit by November, is it possible that RBI does away with this instrument ICRR and manages with VRRR, FX swaps and other instruments just for the 2 months, and they are going to get some help from advance taxes? Is that a possibility?
I know that Prasanna thinks that inflation has little role to play in this liquidity considerations, but my sense is that this whole 2,000 rupee note linked infusion of additional liquidity into the system was very well known at the time of the announcement in the month of May itself. But initially, RBI did not announce any tightening of liquidity, most likely because inflation at that time was very benign. Now, as inflation has crossed some critical thresholds, RBI has to be slightly more concerned about where this liquidity is heading. I understand that compared to their earlier studies, that 1.5% of NDTL, the current liquidity is still not higher than that threshold limit. But still, given how the asset markets are behaving, I will not be surprised if RBI, for the time being, till inflation numbers come back into more comfortable range for RBI, keeps liquidity slightly on the tighter side. I think that will be a prudent policy. There are still enough uncertainties on the inflation with bad rainfall in August and early September. So why take a chance and ease liquidity now and then later on find that that can turn out to be more inflation?
Yeah, that's absolutely correct. I mean, on May 19th, when the 2,000 rupee note policy was announced, at that time, inflation was not expected anywhere at 7.4. You know, the RBI's average was, I think, 6% or even 5.8 for the second quarter. Only then they increased it to 6.2. So they were not aware that tomatoes and El Nino can, create such a big problem. Just a final word from all of you. There is a deliberate reason why I have invited the two of you. I want you to state on the record, what is your best guess? What will RBI do? Samiran, I think yours is there in black and white.
Yeah, I mean, I think the ICR will continue in some shape and form. Maybe 10% will get reduced a bit, but I'll be slightly surprised if it is completely removed after just 1 month.
Prasanna?
Yeah, I think they'll reduce it to 5%.
Okay. And I'm going with they will remove it. Let's see. We should know perhaps in an hour, perhaps in 2 hours, perhaps in 4 hours. But we will know what RBI is going to do. Wrap up on Bazaar on that note. Chartbusters updates.